Hey everyone, welcome to this week's episode of Economics Basics. Today, we're going to dive deep into the world of inflation and credit, and how they are affecting the price of goods at a grocery store near you. It's no secret that prices have been on the rise for some time now, but there have been huge increases in the price of eggs in particular over the past few months. According to Urner Barry data, wholesale egg prices have been declining more than 50% since December record highs. At the same time, the New York Federal Reserve released its monthly survey of consumer expectations for March, which showed that consumers are becoming increasingly pessimistic about the future of both inflation and their access to credit. Respondents expect prices to rise by 4.7% in the next year, which is still higher than the 2% inflation goal set by the Federal Reserve. Gas prices are also expected to increase 4.6% in the next year, while food prices are projected to climb by 5.9%. On top of all this, credit is becoming increasingly hard to get, with the number of respondents who reported that credit is much or somewhat harder to get than a year ago rising to 58.2%, the highest ever in the data series. Perhaps most alarmingly, the outlook for missing a minimum debt payment in the next year rose by 0.3 percentage points to 10.9% of respondents. Lastly, respondents showed less optimism about stocks, with only 35% expecting higher prices a year from now. Given this information, it's important to keep in mind that inflation and credit access are two of the most important factors in today's market and can have tremendous impacts on our everyday lives. With this in mind, let's take a look at how we can best prepare for these changes. First and foremost, it's essential that we stay informed about these changes and their impact on the prices of goods. Learning about credit availability and understanding how inflation affects prices can help us plan our finances and budget accordingly. Secondly, we need to be prepared for a more volatile market by diversifying our investments and avoiding any risky bets. We should also look into keeping our savings and investments in a variety of accounts, such as stocks, bonds and cash, as well as investing in hard assets like gold to protect our money against inflation. Finally, it's important to remember that inflation and credit access are constantly changing, so it's important to stay on top of these factors in order to protect our money. Thanks for joining us today to learn about inflation and credit access. As always, we wish you the best in your financial future.